Greetings and welcome to this week's edition of 401k Real Talk. This is Fred Barstein, contributing editor at wealthmanagement.com's RPA Edge and CEO at Trout, TPSU, and 401k TV. I review all of last week's stories and select the 5 most important and interesting ones, providing open, honest, and candid discussion you will not get anywhere else. So let's get real. First story, though just a fraction of their overall business, the acquisition of Putnam by Franklin Templeton shook the DC world. After paying a whopping $3.9 billion in 2007, Great West, controlled by Power in Canada, which also owns Empower, sold Putnam for just $925 million, with just $100 million in cash, as Putnam's assets continue to dwindle at $135 billion, about 1/3 of the $371 billion it had in 2000. Advisors and CIOs will need to pay close attention to which portfolio managers leave or are replaced, requiring extra due diligence, and it may affect Putnam's wholesaling support staff. The sale reminds us that all fragmented industries will consolidate at some point to achieve scale, like record keeping, advisory services, and asset management, as the stakes get higher for those that want to participate in the coveted DC market. Next story, though May's job growth at 339,000 greatly exceeded expectations, there was less concern that it could cause the Fed to raise interest rates, as unemployment rose 0.3%, the biggest jump since April 2020, and hourly wage increases were moderate, as was inflation. Sectors enjoying the greatest growth included healthcare, business services, government and hospitality and leisure. Information services lost 9,000 jobs. The May report indicated a healthy, not heated economy, not likely to result in a recession, according to experts. It does keep pressure on employee retention and recruiting, with the focus still on providing a competitive benefit package, especially retirement plans and holistic financial wellness. Next story, after its UK parent raised another $95 million on the heels of $280 million a couple of years ago, Smart USA continues its push to reinvent itself from a fintech record keeper focused on pooled plans like its UK parent to become a managed account provider, buying ProManage recently after having acquired Stadion. Founded in 1998, ProManage has $4.5 billion, raising Smart's managed account assets to $10 billion, which pale in comparison to Edelman, Financial Engines, and Morningstar, with the latter enjoying a data pipeline to almost 25 record keepers. ProManage also offers financial wellness services. Though managed accounts are the next great thing, driven by the push for personalization, experts predict that they will only take off in DC plans if they are part of the QDIA, which will mean that fees will have to come down and data will have to be more readily available. Next story, iJoin, a participant user interface which combines managed accounts and engagement tools to improve participant outcomes, has partnered with Alaris, one of the larger independent record keepers based in the Midwest and owned by a big regional community bank. iJoin boasted 3 million participants and 65 record keepers before the Alaris deal, and is an attractive option to small providers that cannot afford to build their own participant interfaces. These independent record keepers are attractive options to many RPAs, as some of the larger providers are looking to access participants themselves, potentially competing against the advisors who brought them the plan. Look for Alaris to enter the PEP market with a major announcement expected this month. Finally, Vestwell continues to gain momentum after the announcement of JP Morgan deal, partnering now with Gusto, a large payroll provider. Gusto has fueled the growth of the largest fintech record keeper guideline. So the question is, have they decided to switch loyalties or just provide their payroll clients more choice? Either way, Vestwell wins, realizing not only the critical importance of 360-degree payroll integration, but also the power of payroll providers as a source of leads, especially with the explosion of small and startup plans due to state mandates and Secure 2.0 tax credits. The two firms currently have 1,000 clients in common. So those were the most important and interesting stories from the past week. I listed a few others I thought were worth reading. Please let me know if I missed anything or if you have any comments. Otherwise, I look forward to speaking to you next week on 401k Real Talk.